studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
This slide introduces an important consideration that often gets overlooked when comparing salary and dividends. Many owner-managers focus on the amount of compensation they receive, but salary creates additional obligations that dividends do not. At the center of the slide, we see salary dollars flowing through a funnel and being divided into several different destinations. Only one portion becomes immediate spendable cash. The remaining amounts are allocated to taxes, CPP contributions, and payroll-related obligations. This visual helps us understand that the true cost of salary extends beyond the amount deposited into the owner's bank account. On the left side of the slide, we see the salary route. When compensation is paid as salary, CPP contributions are generally required. In addition, there are payroll remittances, reporting requirements, and administrative responsibilities that must be managed by the corporation. Salary therefore involves both direct costs and administrative obligations. Many owner-managers notice these costs immediately because they see money leaving the corporation and they see deductions appearing on payroll records. Now look at the right side of the slide. The dividend route is much simpler from an administrative perspective. Dividends do not create CPP contributions. They do not require payroll remittances, and they generally involve less ongoing payroll administration. This simplicity is one reason why many owner-managers are attracted to dividend compensation. However, the analysis should not stop there. Notice the statement at the bottom of the slide. CPP is not just a tax cost. It is also a retirement benefit. This is one of the most important concepts in compensation planning. Many people look at CPP contributions and see only an expense. They focus on the money leaving their paycheck or leaving the corporation. But CPP contributions are also helping build future retirement benefits that may provide income later in life. This means that CPP should not be viewed solely as a cost. It should be viewed as part of a broader retirement planning discussion. The key lesson from this slide is simple. Salary creates additional obligations, costs, and administrative requirements that dividends do not. But those additional costs may also create valuable long-term benefits. As advisors, our role is not simply to identify which option has the lowest immediate cost. Our role is to help clients understand both the costs and the benefits associated with each compensation method so that they can make informed decisions based on their overall financial goals. This slide focuses on one of the most important questions in owner-manager compensation planning. How should we think about CPP contributions? Are they simply a cost that reduces cash flow today? Or are they a valuable retirement benefit that provides income in the future? The answer is that CPP is often both. On the left side of the slide, we see the perspective that many business owners have during their working years. They look at their pay stub and notice CPP deductions reducing their take-home pay. They see money leaving their paycheck and, in many cases, they also recognize that the corporation must make an employer contribution as well. From this viewpoint, CPP feels like a cost. The owner sees less cash available today and naturally asks the question shown in the speech bubble. Why am I paying so much CPP? This reaction is understandable because the impact is immediate and visible. Now look at the right side of the slide. Here we see the same individual later in life during retirement. Instead of making CPP contributions, they are now receiving CPP benefits. Monthly payments arrive regularly and help support retirement income. These payments can provide financial stability, supplement other retirement savings, and continue throughout retirement. From this perspective, CPP no longer looks like a cost. It looks like a benefit. The timeline in the center of the slide connects these two viewpoints. During working years, contributions are made into the CPP system. During retirement years, benefits may be received from that same system. This is why the question in the center is so important. Is CPP a cost, an investment, or both? For many clients, the answer depends on their overall retirement strategy. Some clients intend to build retirement wealth through corporate investments, personal investments, real estate, or other sources. They may place less value on CPP participation. Other clients appreciate the idea of a predictable government-backed retirement income stream and view CPP as an important component of their retirement plan. Neither perspective is automatically right or wrong. What matters is understanding the client's goals and designing a compensation strategy that aligns with those objectives. The key takeaway from this slide is simple. CPP is more than a payroll deduction. It is also part of retirement planning. When evaluating salary versus dividends, advisors should not view CPP solely as an expense. Instead, they should help clients understand both sides of the equation, the cost today and the potential benefit tomorrow. The best decision depends on how the client intends to fund retirement and what role CPP is expected to play in their long-term financial future. This final slide addresses a question that often comes up when discussing salary versus dividends. What about employment insurance, or EI? Many people are familiar with EI because it is an important program for traditional employees. However, for owner-managers, EI is usually not the main factor driving compensation decisions. Let's start with the left side of the slide. For a typical employee, the relationship is straightforward. An employer hires an employee. EI premiums are paid, and the employee may be eligible for EI benefits if certain conditions are met. These benefits can provide support in situations such as job loss, certain leaves, or other qualifying circumstances. Because of this, EI is often an important consideration for regular employees. Now look at the right side of the slide. Owner-managers are different. In many cases, they own and control the corporation that pays them. As a result, the normal employer-employee relationship does not always exist in the same way. Special rules apply. Eligibility may be limited, and many owner-managers do not actively participate in EI at all. That is why you see the warning symbols on the right side of the slide. For many owner-managers, EI is often less relevant when designing a compensation strategy. The magnifying glass in the center represents the advisor's role. When examining salary versus dividends, many clients initially assume that EI will be a major consideration. However, once the analysis begins, advisors often discover that the more important discussion involves CPP rather than EI. This is why the message in the center of the slide is so important. Most owner-managers focus on CPP, not EI, when evaluating salary versus dividends. The comparison table at the bottom reinforces this idea. When salary is paid, CPP contributions generally apply. Payroll remittances are required, and there may be some EI considerations depending on the circumstances. When dividends are paid, there are no CPP contributions, no payroll remittances, and no EI participation associated with the dividend itself. But notice what this comparison reveals. The biggest distinction is usually CPP and payroll administration, not EI. This brings us to the key lesson from the entire section. For most owner-managers, the real planning decision is not about EI. The real decision is about CPP and retirement planning. Should the client participate in CPP? How important are future CPP benefits? Does the client prefer retirement income from CPP or from personal and corporate investments? These questions typically have a much greater impact on compensation planning than EI considerations. The takeaway is simple. EI is important for many traditional employees. But for owner-managers, it is usually not the deciding factor when choosing between salary and dividends. The primary discussion is usually about CPP, retirement planning, and the long-term financial strategy that best supports the client's goals.